First quarter 2024 financial results presentation. As this event is being broadcast, we would like to remind those of you in the live audience to please put your mobile devices on silent. Today, Jens Lottner, CEO, will begin with opening remarks, and Alex Macaire, CFO, will share more details of the financial results and business updates, followed by a questions and answer session. Jens and Alex will present in English, with live Vietnamese translation available via separate link. As usual, there will be another call in Vietnamese tomorrow for retail investors. Today's presentation and Q&A will last around 90 minutes. With that, I'll turn it over to Jens to begin the presentation.
So good afternoon, everyone, and thanks for joining this quarter's analyst presentation. And so what I will do is I will just give a very quick introduction, and then actually Alex will take it from there to provide the details, and then as usual we go through the questions and answers. Let me just give the highlights right now. So first one is, I think we probably are looking at a very, very strong quarter in the first 3 months of the year. And overall, probably has been one which is one of the strongest in the history of the bank. But I think most importantly, I think it's a continuation from the acceleration which we have seen since actually the second half of 23. And right now, the TOI stands at roughly 12 trillion, so that's an increase year on year of 32%. And we have seen good momentum across all the different income components, and NFI, NII, as well as other income, and which also, together with very strong cost control, actually has led to a PBT before tax of 7.8 trillion, again increase of 40%, more than the TOI growth, just because we controlled actually our OPEX very, very tightly. Cost income ratio stands at 26.5% for the quarter. Again, probably that is more an aberration, and we will start catching up. But again, I think it just basically shows that we are able to acquire customers, to earn money, and even while keeping our expenses relatively flat. And return on asset is a little bit down, and again there's a favorable trend quarter on quarter, and we're still a little bit away from the 2.9%, but we actually expect that this will get better over the year. CASA, and we again seen now 4 quarters of growth on the CASA side, and so we are above the 40%. And on both areas, on corporate accounts as well as on retail accounts. And we probably see an even stronger inflow than what we've seen in the past, but actually the outflow is also very, very high. And just because our customers right now are investing in other asset classes, gold, stocks, bonds, real estate. Again, for us, that basically is a good sign that the economy is actually coming back. And as we always said, given the fact that our customer base is more towards the mass affluent side, we should actually see continued good customer momentum, and also from that piece of the business. NPLs under control, a little bit down and roughly stable at the 1.2% mark. Coverage ratio has improved to 106%. Again, and we continue on a very prudent risk management policy. And again, we also made this comment again and again, that we believe that our book, even during the crisis, is behaving very differently than the rest of the competitors. And again, I think we will see that this will actually continue for the rest of the year. CAR has been coming down a little bit. The main reason for this is that we have seen very strong growth in the fourth quarter of last year, but also in the first quarter of this year. And therefore, as we start putting retained earnings into the equity, and that will probably run a little bit behind. So we should actually see that this number will increase as we will continue putting earnings into equity, and as probably will not continue on that credit growth, which we've seen in the fourth quarter and the first quarter of this year. So as this tames down a little bit and earnings are catching up, we will also see that CAR will be going up and rather into the 15% range, and as what we have advised before and where we are usually over the last couple of years. So therefore, it's a very, very strong performance, and we actually look pretty positive into the next couple of quarters. So we hope that this is not really an aberration, but again, I think it just shows the underlying earning strength of the bank, and therefore, I will hand it over to Alex to give you a little bit more details in terms of where this momentum, this earnings momentum is actually coming from, and what we probably should expect for the next couple of quarters. Alex, over to you.
Thank you, Jens. So as usual, we will start with an overview of the macroeconomic environment. And the quick take that is quite supportive at this stage of the year. So we have a hot US economy. We have also the perspective of a gradual recovery in Europe. And clearly, Vietnam economy is gathering pace. And this translates into an increase of export by 17%, of imports by 13% year on year. During the first quarter of the year, as you know, the economy registered a 5.7% increase in GDP with very robust contribution from the manufacturing and construction sectors. You can see as well that the PMI index is now back above 50. So all these is quite favorable, and meanwhile the foreign investors continue to take a very positive perspective about Vietnam, and as a result of that, on the FDI, so foreign direct investment, continue to track in line with anticipations. So the real economy, in other terms, is performing well, gathering pace. There is only one area to watch out for, which is the FX rate. So clearly, with the decoupling between the interest rates in US dollar and the interest rates in dong, there is some pressure on the value of the domestic currency. And this is also something we will have to look for as we make our anticipations for the rest of the year. So turning now to the financial markets. So I think the key point to highlight is obviously the fact that the growth of the credit books in the banking system have been a bit disappointing during the first quarter, only plus 1% year to date. Obviously, it's quite different from what we are seeing and quite different from the growth of our own credit books. And it can look a bit paradoxical given that the economy is gathering pace. So one possible interpretation is that some of the strong asset growth that we saw at the end of last year was technical, and by this I mean that some banks may have brought forward disbursements which were due to be made at a later point in the year. But overall, what we saw in the first quarter is moderate growth on the asset side, ample liquidity, and this means that we had low interest rates on both sides of the balance sheet. We believe that we might be, however, at a tipping point. First, because the stock of excess credit supply might resolve. And secondly, because we are seeing that the Central Bank of Vietnam is gradually withdrawing liquidity in order to protect the value of the dong. And as a result of that, we believe that interest rates going forward might be on an upward trend, and potentially they could increase by in a range of around 100 basis points, even more compared to today. So at this point in time, what it means for us is that we are focusing very hard on optimizing our cost of funding in order to be as competitive as possible on the lending market. And we are at the same time also preparing ourselves for what is coming, which is a very likely increase in interest rates. So moving now to the financial results of the bank. So I think Jens mentioned it. it's been a very good quarter for the bank. Our NII benefited from both an increase in the net interest margin and a very robust growth in our assets. On the fee side, we saw a remarkable turnaround of our investment banking fees with a very robust momentum. Meanwhile, we were able to keep our costs under tight control with a moderate 3% increase quarter on quarter. Jens mentioned it, we managed to grow our CASA back to number one position in the market. So all this is very positive. So this gives you a little bit more details on our P&L for the first quarter. So we generated 12.3 trillion of TOI, which is the highest in the history of Techcombank, a PBT of 7.8 trillion, which compares to 5.9 trillion in the previous quarter. We grew NII and NFI by 30%. Meanwhile, our other income grew by 73%. We were able actually to generate trading gains, leveraging the volatility in the interest rates and FX markets. Our OPEX grew by a moderate 3.4%. Our credit cost was up year on year, but down quarter on quarter. So looking now at our balance sheet. So as you can see, we grew our assets by 24% year on year, which is significantly more than the rest of the industry. On the funding side, I would like to highlight our groundbreaking results when it comes to the distribution of our certificates of deposit, which we call CD Baulock. As you know, and as I explained in a previous presentation, this product is quite unique in the market because it's exchangeable, which means it combines the benefits and the flexibility of a current account with the higher rates of term deposits. And this quarter, we added on top of this product an auto sweeping mechanism to design a product and an account called auto earning, which has proved a key driver to attract a new customer in the first quarter and also allow us to expand our deposit base while optimizing our cost of funding. It's also a very competitive way of raising long-term funding. So this product, auto earning, was a key driver in the reduction in our cost of funding, which reached, as you can see here, 80 basis points during the quarter. Meanwhile, the yields on the assets softened a bit, but not in the same proportion. And as a result of that, our net interest margin improved further, reaching 4.4% for the quarter and 4% on a last 12 months basis. So robust asset growth, as I mentioned, so plus 7% for the quarter, the same level as the fourth quarter of 2023. Obviously, it's significantly more than what we had seen for the rest of the industry. From the 1st of January 2024, we have, as you know, merged our wholesale banking and business banking division into a new structure called Corporate and Institutional Banking Group. And this allows us effectively to be a lot more effective in developing our value chain approach across entities of all size, starting from large corporate all the way down to mid-market businesses. And on the retail side, we have transferred the micro SME and emerging SME customers to the retail banking group, allowing us as well to develop integrated propositions catering to the needs of business owners across both their personal finances as well as their businesses. So if we adjust for this change of perimeter, then our corporate loans and bonds increased by 10% during the quarter, while our retail loans within RBG stayed broadly flat. You can see as well on the right-hand side of this slide here that we have significantly shortened the duration of our assets during the first quarter. This gives us a lot more flexibility going forward to reprice our assets as the interest rates increase. So this slide gives you more detail on our credit exposure. Like in previous quarter, the growth of our real estate books of plus 8% quarter on quarter is linked to the funding needs of the projects in our portfolio and their maturity stage. We didn't add any new projects during the quarter, and all the projects that we funded during the quarters are selling well. I would like also to highlight that we have a very precise trajectory in order to ensure that we reach our target by the end of the year, which is, as you know, to keep our real estate exposures flat in absolute terms. And so far, the bank is performing and tracking in line with this internal operating plan. Finally, I would like to highlight the significant growth achieved in the other sectors. You can see here the growth achieved in FMCG, particular utilities, telco. So all this is evidence of our determination to continue and pursue the diversification of our credit exposures. On the retail side, we can see that on the new perimeter, which includes emerging SME and micro SME, then the allocation of our credit portfolios by product is quite balanced. The one area where our performance has been a bit mixed is the mortgages. So you can see that balances have increased only by 1% quarter on quarter. Actually, new disbursements have been very high, but it's been largely offset by a significant volume of early repayments. So other banks are targeting our customers and offering very low interest rates in order to convince them to move their mortgages. So we have identified this issue, and we're working on strategies to protect our mortgage book going forward. So here we wanted to give you a bit more details on the structure of our real estate book. So on the left-hand side, you can see that actually a large proportion of our real estate corporate books, more than 90%, is made up of something which is very clear and very simple: residential properties in prime locations in Hanoi and Ho Chi Minh. Right, so that's very clear. And then you can see as well that when you look at the portfolio in terms of maturity stage, though there is only 2% of our credit exposures which relate to land, and in these cases, in any way, we have a clean and clear legal title. We have around 19% in design and build, and 80% in build and sell and later stages. So this means that it's a portfolio which is quite mature and quite should have the ability to translate relatively quickly in repayments. On the right-hand side, you see the mortgage prepayment rate as well as the mortgage disbursements. And as I said, you can see that the level of disbursement that we've seen on mortgages in the first quarter of the year has been actually very strong and comparable to what we saw at the first quarter of 2022 when the real estate market was very hot. So it's absolutely clear that the real estate market is warming up. And the fact that it doesn't translate into a higher balance on our mortgage books is, as I said, due to the very intense competition from the other banks, which are pricing extremely low in order to target our customers, and we will act on that so it stops. So now we will look at our deposits. As you know, we ended 23 with a very strong deposit base. We had actually accumulated more liquidity than we needed, and the reason we did that is because we anticipated a very robust growth in our assets in the first quarter of the year. As a result of that, we didn't need to attract and collect any new term deposits during the first quarter, and we rather focused on optimizing our cost of funding as much as we could. And as you see, we've been quite effective in this area because our average cost of deposits has gone down by 90 basis points during the first quarter of the year. Meanwhile, and Jens mentioned it, we were very happy to be able to not only protect but actually grow our CASA balances during the first quarter of the year by 2% quarter on quarter, which is quite different from the rest of the industry. And this proves the strength and the resilience of the digital franchise we have built over the quarters. Adjusted for the change in perimeters, retail CASA were up 1% and corporate CASA were up 3%. So as you can see, we have built a very strong CASA base in our corporate bank as well. And this is due to the investments we have made in our global transaction banking platform, which is now leading in the market. And we have also rolled out some groundbreaking products like C-Cash in partnership with Kiriba, which is a unique cash management and cash optimization product targeting middle-sized entities up to large corporates. Let's look now at our fee income. So this has been another area of strong growth for the bank in the first quarter. As you've seen, the turnaround in our investment banking activities has been quite impressive, plus 164% year on year. And this proves the importance of this business for Techcombank and for our wealth franchise. We have seen also very strong performance in letters of credit, cash and settlement, as well as credit cards on the back of revamped propositions across all tiers. There is only one area which is down year on year, which is Banca, one main area, Banca. The markets continue to be muted, so the investor and customer confidence remains quite fragile, and there is also the overhang of new regulations, which going forward will limitate and also restrict both the level of commissions that bank will be able to receive, as well as potentially the range of products that they will be able to sell. However, so our APE was down 25% year on year, but the market overall was down 50%. And if you look at the months inside the quarter, then we finished the quarter a lot stronger than we started it, with the number 2 position in March in terms of APE. And we are therefore more comfortable and more optimistic about our performance for the second quarter of the year. Cost-income ratio, so I think the chart speaks for itself, right? So we have managed to increase our cost by 3% only year on year, which in a developing market with significant salary inflation, I think is quite an impressive achievement. Our staff costs in particular were exactly 0%, completely flat year on year. We managed overall to reduce our cost by 9% quarter on quarter. And I think this is evidence of the efficiency gains enabled by the investments that we have made in our digital technologies. So as Jens mentioned in the AGM on Saturday, we estimate currently that around 33% of the profits, I'm insisting on that, the profits of our retail bank is now entirely derived from the digital channel, where the cost to serve is around 10 to 15 percentage points lower than in the traditional brick and mortar channel. So as a result of this very strong cost control and the progression of our TOI, we managed to achieve a cost-income ratio of 26.5%. So achieving such a low cost-income ratio is obviously a very pleasing achievement. However, I would like to highlight the fact that it's not our primary management objective. Our primary management objective remains to maximize the growth of the profits within our forward-looking return on equity appetite. And therefore, we will look at opportunities to redeploy this investment capacity in those areas where it can make a difference. And we maintain our guidance of a 30 to 35% cost-income ratio. Looking now at our asset quality, so Jens mentioned it. it remains extremely strong and under control. So our specific provisions and general provisions in total went down by 26% quarter on quarter. Our NPL balances stayed flat. Our NPL ratio stayed flat. Our also coverage ratio improved to 106%. So all this, I think, is positive and in line with the guidance we provided and for the previous quarter. So this is a lot of details, but we want to be also transparent with our shareholders and investors. So you can see here how our NPL and Bucket 2 special mention loans moved from one quarter to the next. We also break down between organic generation and CIC or Credit Bureau induced NPL. So a few takeaways. The first one is that we saw an uptick in special mention loan. You can see that around 3.3 trillion organic. But I would like to highlight two important facts. First is that it's linked to a limited number of mortgage customers, essentially having litigation with the developers. And these situations have already been addressed, and therefore you can already assume that a significant proportion of the emergence of Bucket 2 that you are seeing here will move to Bucket 1 in the second quarter without any contagion to our NPL. The second thing I would like to highlight is that our NPL balances, as I said, stayed flat. We are quite pleased with our workout. As you can see, the collection ratio in particular is quite strong, allowing us, as I said, to keep NPL balances flat. I would also want, also again, in the spirit of transparency, to highlight the fact that we had 7.6 trillion of assets under Circular 2 at the end of the first quarter, but as we speak, 5.8 trillion have already moved back to Bucket 1. So as of today, our amount of assets under Circular 2 has already reduced by 5.8 trillion compared to what you are seeing on this slide, and therefore we are very confident that at the end of the second quarter, the total amount under Circular 2 will be below 1.6 trillion. So this is another slide on the health of our asset book. So as you can see, first, the loan to value reduced significantly this quarter on the back of the revaluation of the collateral in our loans. So that's a confirmation of what we told you about the fact that we have a 92% collateralization ratio, so 92% of our credit exposures are collateralized, and they are collateralized with collateral which is worth 2 times the amount of our exposures. So I think this is why we are very confident, essentially, about the robustness of our credit books. You can see as well that the average interest rates within each interest rate bucket continue to increase during the quarter, and you can see as well that amount of receivables over interest earning assets edged up a bit, but remained essentially within our risk appetite. Capital and liquidity positions remained very robust. During the last 2 quarters, during the last 6 months, we essentially increased our assets by 14%. Right, so that's quite significant, and this is why you can see that our capital adequacy ratio reduced slightly to 14.2% because we had an immediate impact to our RWAs, and we didn't have time to generate earnings to support those RWAs. However, at 14.2%, our capital adequacy ratio is entirely within our risk appetite. We have a 2.6% or return on asset on a last 12 months basis, 2.9 on a quarterly basis, so it's very clear that the bank has more than enough capital to support its dividend policy and support also, more importantly, the continued growth of its asset. As you can see also, our leverage ratio at 6.4 times is actually one of the lowest in the entire banking industry. In terms of funding mix, the balance sheet of the bank is as strong as it's ever been. You can see in particular that the ratio of short-term funding to medium and long-term assets has gone down to 25.1%, which is a lot lower than the regulatory minimum of 30%. So you can see here how we compare to the rest of the industry with the results we published yesterday and the exciting perspectives ahead of us. We are very confident that Techcombank will be ahead of the competition again and by a significant margin in the coming quarters. Moving now to the full year 24 outlook and starting with the growth of the economy. So first, there is upside clearly to the forecast on the global economy. Last quarter, we estimated the growth for the year at 2.8%. We have revised, based on various sources, our estimate to 3.1%. And therefore, we keep our forecast for Vietnam's GDP growth unchanged at 6%. And this is supported by a number of factors: continued inflows and FDI disbursement, accelerated government disbursement expenditure, recovery in domestic consumption, very strong manufacturing and construction production. So all this should support the 6% growth that is currently basis of our forecasts. So looking now at our guidance for the full year, starting with credit growth, there is a clear possibility that we get a higher credit quota for the year. Currently, our projections are based on a credit quota growth of 16.2%, but as I said, it's very possible that we get a higher credit quota. Our cost of funds, as I mentioned, went down by 90 basis points in the first quarter. We believe it will continue to go down in the second quarter. But beyond that, interest rates will start increasing, and therefore the gains going forward beyond the second quarter will be more limited. Our CASA ratio was 14.5% at the end of the first quarter. Going forward, we will look to continue to increase it. However, we need to be conscious of the fact that if interest rates increase, then we will have some headwinds, and therefore any further progression in our ratio will have to come from our organic initiatives like the auto-earning product I mentioned earlier, like the reward also platform we have rolled out. On net interest margin, though, there is clearly some good momentum. As I mentioned, we were at 4.4% on a quarterly basis. We think we will continue to maintain this in the second quarter. And for the full year, we think that we have potential to reach the 4.5% mark. NII growth will be clearly going double-digit, supported by both the expansion of our assets as well as the improvement on the NIM. NFI, we believe, also will be strong and double-digit. Our capital cost-income ratio should be at the lower end of the 30 to 35% target range for us. And as regards our NPL and cost of risk, it should be broadly in line with the levels reached in 2023. So overall, in a nutshell, last quarter we said that we were seeing a much more supportive environment for the bank. And I believe that the results which were published last quarter and yesterday amply prove the point and even more. So right now we have a bond market which is performing quite well, a real estate market which is coming back. We have an upward trend on our NIM. We have a credit asset quality which is strong. We are outperforming the market on CASA growth, on asset growth, and we haven't even yet started to recover the interest rate concessions made in the past as part of our flexible pricing policy. So clearly, for me, it is a very robust and strong set of results by any metric. And on that basis, we are very confident in our capacity to achieve, and for that matter, exceed the PBT guidance for the year. So this finishes my presentation. We will now move to the questions and answers. Thank you.
Thank you, Alex and Jens. Before we start the Q&A session, just a few notes and based on some feedback we received. We're making a few changes this quarter. In order to keep things moving along, we're going to skip a number of questions that refer to financial guidance or requests for some detailed financial metrics that are already in Alex's presentation just now or were mentioned in the AGM. So we ask that you refer back to those presentations that will be posted online shortly after the conclusion of today's event. And IR, of course, will always be available to answer more detailed questions should you need after referring to those. Let us now begin the Q&A session. The first question is for Alex. Could you share your expectations on foreign currency FX and interest rates in the remaining quarters of the year, especially whether you expect an increase in the interbank interest rates and whether that would affect the bank's cost of funds for 2024?
Yeah, thank you for the question. I think it's clear on, that this is the one area that we need to watch out for. So as I mentioned, that there is clearly a pressure on the FX, and that's the main reason why the central bank is gradually withdrawing liquidity from the banking system in order to support the value of the dong. And that is going to be one of the factors which will drive up interest rates. As I mentioned as well, we estimate that the interest rate could increase by around 100 to 130 basis points between now and the rest of the year. So as far as we are concerned, we will obviously see the impact of these increasing interest rates if it materializes on the cost of our term deposits. And therefore, any actions we can take to offset this increase will have to come for either optimization of the structure of our deposit base. So we are already taking this parameter into account in our pricing strategy and term deposit strategy, or it will have to come from, as I mentioned, our strategy to increase our CASA ratio in the coming quarters. So we are already able, as I said, to anticipate what our cost of funds will look like in the second quarter, and therefore we believe for this reason that we will be able to continue to reduce our cost of funds and maintain the net interest margin at the same level at what we observed in the first quarter of the year. And when it comes to the full year, as I said, we hope to be able to achieve the 4.5% mark.
As a follow-up to that, Alex, what are management's biggest concerns regarding risk of the overall macro environment? And then related to that, the health of Vietnamese corporates in particular?
Yeah, so basically we are seeing some momentum in the economy. I mentioned the first quarter was strong in terms of GDP growth, plus 5.7%. Importantly, now the manufacturing and construction sector is also gathering speed. So that was not the case last year, and it's a relatively quite significant proportion of the GDP of the country, and therefore we do not anticipate any significant deterioration in the creditworthiness of our corporate customers. And meanwhile, as I mentioned, we are quite positive about our capacity to contain the cost of risk in those areas where we had seen some headwinds in the first quarter, including on the mortgage side. So for this reason, we believe that the overall environment is supportive, right? Particularly for banks like us, which have a very strong franchise with one of the best and most respected brands in this market, as was evidenced by the award recently granted by Global Finance, making Techcombank the best bank in Vietnam. So I think when you have the momentum that we have at the stage of the quarter, the ability that we have also to select the risks that and the customer that we want to bank with, this makes us very quite confident in our capacity to continue to support our customers and the growth of the Vietnam economy while maintaining our cost of risk at a level which is equivalent or lower than what we saw in 2023.
Thanks. Next question is for Jens. Jens, will retail or corporates be the main driver of credit growth for Techcombank this year?
So I think that's a good question. And as we said, we actually want to diversify away from corporate. And we actually are interested in really expanding our book in SME and retail. And however, the question, of course, is as well when. And I think the reason why we stayed very much on the corporate side last year was that we actually seen that the risk was lower and in that segment just because the income streams for some of the large corporates are much more stable. And secondly, even the appetite for investments is a little bit higher because they're pre-running some of the cycles and therefore have a little bit more buffer to take up opportunities. I think SMEs and retail will be coming back, but also, as Alex has just showed, right? If you look, for example, at mortgages, it's not like that mortgages are not getting disbursed, right? So just for us in the quarter, and we're dispersing around 23 trillion, but at the same point in time, there's a high prepayment rate for those customers who actually have the funds. Because given the low interest rate environments right now, a lot of customers who can afford it are basically saying, why should I take after the soft start period? Why should I actually continue with a loan? And therefore, they're actually paying back. So a little bit like you're dispersing while you get the same amount of money back in. And from that perspective, and we will see, again, a shift into the retail and SME book, but will it be very massive? And I think that really needs to be seen. Again, if we see a major uptick again in the real estate sector, and if we also see that probably SMEs and the export-oriented sectors, if that continues to actually be strong also in the second half, then I think we will probably see a somewhat stronger shift into SME and retail. And otherwise, again, I think probably it will be still more on the large corporate side, but then again, as Alex said, away from recom into some of the other sectors.
Thanks. As a follow-up to that, and related to what the chairman said at the AGM, that Techcombank will focus on SME and consumer finance. Is this a near-term or long-term orientation that he was talking about? And could you share how Techcombank will approach these segments differently versus other banks, given the difficulty that some have had in cracking these sectors?
So to a certain extent, it's not near-term, long-term, it's actually a kind of ever-term, because the idea always were that the bank is strategically interested in the developing middle class. So if you think about even the sectors we're in on the corporate side, are rather industries which are really banking on the developing middle class, be it travel, entertainment, auto, real estate, fast-moving consumer goods. And then on the retail side also, especially the mortgage side, is clearly actually a retail area. And the reason why we are so much involved in the development or real estate development is actually that we are finding it a good way in order to help our retail customers to actually build wealth. So therefore, I think there's no shift. What might be a shift, and that is clearly an area we're going into, that we're saying we're going a little bit deeper in terms of the segments, meaning not just large corporates, more into middle market, SME, and not so much in just mortgage at the affluent side, but also mass affluent, credit card, and if you want, so consumer finance loans. But clearly we don't want to go into areas like an FE credit. And however, how are we doing that? Again, this is backed by this is backed on the one hand by digital. So we really want to reach out to our customers through our digital channels. But in order to make sure that we really are successful from an economic model, if you think about how you can actually make money in that area, is you need to control three parts of the cost, right? So you need to actually have acquisition costs down. You need to make sure that we reduce our risk cost and our operating cost. So acquisition cost, we will probably work closer with ecosystems, either that we are using leads from big anchor customers on the large corporate side, or we're actually working with companies like Masan in the Win Life ecosystem, that we actually can reach out to customers digitally, but also through partner channels. The risk cost is very much depending on our quality to underwrite very differently. And we have reiterated again and again that we invested tremendous amounts of money into our data infrastructure. And I think this now starts panning out. So we will actually start developing very, very different risk models than what currently is available in the market. And I said at the AGM that we are every day storing around 5 billion records, which allows us to actually understand our customers and the risk profile of our customers very, very differently than probably anybody else in the market. And that allows us to select much more carefully, price much more carefully. So either we take the same risk at a better price, or for any given price, we might actually be willing to extend more collateral because we have a much better understanding of that risk profile. And so that risk cost will mostly come really from a better understanding of our customers. And then operating costs, ultimately, all our processes are pretty much automated. So again, what I said in the AGM, if we look through everything what happens on our digital channels compared to our physical channels, we're running it at 10 to 15 basis points lower when it comes to CI ratio. And if we see our overall CI ratio at 26%, you can roughly imagine at what levels we are talking about. So therefore, again, we always wanted to be in that space, and we have built the capabilities over the last 2 or 3 years to be more aggressive. But again, we also want to be sure that if we're going in there, we're not going while the cycle is actually very adverse and not very benign. So therefore, and we will make very careful moves, but as we see that the economy is really sustainably turning, as we see that, again, there's more confidence on the SME side, as there's more confidence also on the consumer side, consumer confidence, I think that's when we start expanding the book. But again, from the business model and operating models, we are pretty much geared up, and it's actually our decision, not so much on what we are doing. I think it's much more a question, when are we doing it?
Thanks. Next question is also for Jens. Would you agree with some third-party observers that are projecting a recovery in real estate this year? And then could you update us on the progress of key real estate projects that Techcombank is financing to see if they support these assertions? Based on that answer in the first part, has Techcombank changed its outlook for the flexible payment scheme that you previously said is going to end by the end of 2024?
So, and we shared in the presentation which Alex just gave a couple of these information, but maybe it's worthwhile reiterating. So first one is, you look, and again, we're not the whole market, right? But if you look at our disbursement, right, you see that second quarter 2022 was a complete aberration. I think the market went completely out of control a little bit. But if you see right now where we are in disbursements, we're roughly at the same levels like first quarter 22 and the third quarter 2022 before actually all these events unfolded. And that is pretty much still a very, very good and strong performance. So therefore, at least from what we are seeing, is there is huge demand for real estate. And the reason why our numbers are pretty good is, when you go to the left-hand side, is we actually have a lot of our projects which are legally clear, ready for sale, and therefore, they right now start handing over projects or pre-selling, and therefore the mortgages are coming in. And I still think that, again, when it comes to projects, we probably would need more projects. And if you look into Ho Chi Minh City, only one project has been actually approved for the whole year. I think the north looks a little bit different, and I think you just saw a couple of the an announcement made when Vinhomes launched their big project in Haiphong. And I think basically in the first months, 1,200 units were sold, and you see still Ocean Park. You see a lot of these big projects are still actually going very, very strong. Ho Chi Minh is a little bit different, and just because I think we have less projects with these clear legal titles. But again, from an underpinning demand, the demand is still very, very strong. And therefore, what we are seeing is, in the projects we are having, is our clients developing. And as we said, we pre-finance that. That is when we talked about the flexible pricing, because when the markets were in the lows, like first quarter, second quarter, these developers didn't stop, but they continued to basically develop. That is when we went into the pre-financing, and now you see that the mortgages are coming in, the sales are coming in. That's why the disbursements are going up. So we expect that to continue, and so we expect the second half to become better. We believe that some of the projects which have legal troubles with other banks, that they will actually come out of these troubles, that there will be more supply. But clearly there's demand. It's really a question just of supply, but from consumer confidence, from the willingness to invest, from the surrounding investment parameters, which is relatively low interest rates, still interesting asset classes, and yields on the credit side very low, and appreciation, especially now in Ho Chi Minh City, of good locations. And we actually expect that this trend will continue. And again, those developers who have now clear projects, good titles, and will be in a very, very good position. And again, for the market, we can just hope that there will be more projects getting out of that freeze period. Legal and rights are very clear, and which would actually help the overall market. And sorry, last one. No, we have not put in any recovery yet from the ones where we basically applied the flexible pricing policy. We see already some indications that some projects, and really goes project by project, might consider potentially accelerating some of that. But again, given the fact that we want to be very conservative, we have not put anything into the books. And again, once we see second half, once we see how that's developing, we might actually accelerate, or we see an acceleration, because ultimately that is very much dependent on the developer and how the developer decide to use the flexibility we've given them with the payment terms. And so if they decide that actually now they are really in the position to start prepaying, accelerating the payback, then we will book these concessions. But again, at this point in time, we are just very conservative. Could happen, but nothing so far what is in the guidance.
Thanks. Next question is for Alex. Total bond issuance for the market was very low in the first quarter of 2024 as compared to the first quarter of 22 or even 23. Was this in line with the bank's expectations? And what is your forecast for the full year? And how long do you think it'll take for the bond market to fully recover? And then the implications for Techcombank's bonds-related fees?
Yeah, thanks. A very, very good question. I think I had exactly the same observation when I saw the volumes for bond origination in the first quarter. That there is a very simple explanation, that there was a change in regulations, right? And the market needed a bit of time to adjust. And as consequence of this change of regulations, now most bonds have to be listed. And the SSX, which controls with the regulating body for the bond market, is also a lot more cautious to approve the new bond issuances. So that's created some delays. What we expect, however, is that the second quarter will be a lot stronger than the first quarter, and volumes for bond origination could be even double. So we will see in the market. But you can expect that the origination fees for Techcombank will increase significantly in the second quarter compared to the first quarter. It's difficult to make predictions for the full year, but if what we are seeing today, which is a combination of restored investor confidence, also investor appetite for bonds given the increased yields, and also a better understanding from issuers of the things they have to do in order to access this market, if all these factors remained there, then we should see a continuation of the positive momentum on the bond market, as reflected in the very strong results published by TCBS and published by TCB in respect of the investment banking activities.
Switching to the question on bonds on the balance sheet, could you provide information on the bank's exposure to corporate bonds in terms of percentage of assets? And then are there any plans to reduce that exposure or to maintain at the current levels?
Yeah, thanks. And very happy to touch on this topic again. So I would like to make one important remark to open the topic, which is that there is a perception from some investors that the corporate bond market is intrinsically more risky than loans. I think this might be true for a specific part of the market where we saw some unhealthy practices in the past, like some issuers self-issuing the bonds, or some market players applying less stringent professional due diligence in the origination process. When it comes to Techcombank, we originate bonds in exactly the same way as we originate loans. So I would like to repeat that point again, and this means that the credit experience on our corporate bonds is exactly the same as the credit experience we are seeing on our loan portfolio, which is exactly 0% NPL for those exposures. Now, when it comes to the reason why we have bonds on our balance sheet, it's very simple. Actually, our customers need to invest in those products, which generate predetermined and fixed income streams over a fixed period of time. And in order to be able to distribute these products, we need to originate them in the first place and warehouse them on the balance sheet for a period of time. So we currently have around 40 trillion of corporate bonds on our balance sheet. We believe that's the right volume we need in order to cover the needs of our retail customers, and therefore we believe that in the foreseeable future that there will not be any significant change in the amount of bonds in our balance sheet. But in any case, even if it was to change, it would not mean anything in terms of the risk exposures of the bank, because again, corporate bonds and loans are originated with the same criteria in the same manner.
Thanks. Next question is for Jens on the banker market. Given the trend towards stricter government regulations recently, has that impacted the growth of the market, and what are your growth strategies and outlook for banker for the next 4 years?
So probably it has not affected yet, and the reason is because it's not in effect yet. And so therefore, and we'll see what's happening. Overall, the banker market is still pretty much affected, to be fair, and we still probably have the last quarter of massive kind of depression, because the whole crisis unfolded somewhere in the second quarter, so the first quarter still looked actually pretty strong. And therefore the year-on-year for the overall market is actually still roughly 52% and down and compared to year-on-year. Now, for us, the same number actually is down 25%. And so, yes, we are affected, but again, I think we are performing better than the market, but we cannot escape the market and the market development. In terms of the regulation, we still need to look exactly on how that will actually pan out. And there's a circular from SBV, which they have requested for input, and the input is coming from different associations, but also from the banks. Again, from our perspective, we are pretty clear. We think that banks should actually distribute insurance products. It's an important product for our customers. It's an important financial need. And we believe we're actually well positioned to deal with it. I think the regulator should do exactly what they started doing, which is controlling the quality of and the way how this business is executed by the banks, but not taking the product out, but just making sure that the banks are doing a good job in advising correctly, not mis-selling, doing need-based analysis and all of this. We are pretty, if that's the approach, and I think we are pretty comfortable with that, because we believe there's the need. And even during the entire crisis, when there was a lot of cancellation of policies and all of that, when it really came to these cancellations where we're saying is missold and all of that, right? I think the overall amount even raised to us were 60 cases of the entire customer portfolio. So we are very sure that the products we are selling are actually the right products. They're done in the right manner. But if there's an overall blanket kind of disapproval of banks distributing these products, that of course would affect us. But we don't know exactly how that will pan out. Maybe certain products are not allowed, which again would still not be ideal, but again probably could be managed. But it really comes to cannot, that is a different scenario, but I don't really see this playing out right now. I think there might be some restrictions, some checks, some quality checks. And for us, as we said, we believe quality will then just speak for itself. So, and we know that in March this year, we were number 2 in bank assurance, pretty much tied to the number 1. And I think also this quarter, it looks very much like we are leading the industry when it comes to bank assurance. So, and we believe the right product goes to the right customer, and it's still something which we should be doing. But if the overall market still is not coming out, if there still is a kind of mistrust or some loss of confidence, then it would be very hard to get ourselves out of that. So we expect this year banker to be better than last year. But will we get completely to where we believe the market should be? And that might actually still take some time. But again, we still hope that every year and going forward, it should actually be going back rather to the old growth trajectory, albeit and starting from a different level, from a lower level, and then it comes down to the individual bank and how much of that renewed market momentum they can actually capture. But again, I think we try to get back to be the number 1 position, or to have the number 1 position in the market.
Thanks. The next question is for Alex. There seems to be a bit of a lag in the NIM measured on an LTM basis, even though you showed a stronger uptick in NIM when measured on a quarterly basis. What is the trend that you expect for the rest of the year?
Yeah, thank you. So I would say it's difficult to make any reliable projections for the second half of the year, given the fact that the interest rates could increase significantly, as I mentioned, up to 100 or even 130 basis points between now and the end of the year. And it's very difficult to anticipate how the other banks will behave, right? How much aggressivity they would put in their pricing. If we look at the first quarter of the year, you can see that they have been extremely aggressive. I think I would not be surprised to see the net interest margin of a number of banks decreasing, and in spite of that, they have struggled to grow credit books. So you can expect that they will continue to price very, very aggressively. What I can say that for the second quarter of the year that I mentioned, we still see a potential for our cost of funds to continue to decrease, and we see a potential for us to maintain our NIM to the level we've seen in the first quarter, if not improving it a bit, and seeing at the year overall, right? So we hope to be able, as I said, to achieve a 4.5% in net interest margin.
Thanks. The next question is for Alex also. NFI seems to have slowed down this quarter to single-digit growth. Could you discuss what was behind that, and do you still expect an 18 to 20% growth for the future?
Yeah, no, thank you. So I think you're right regarding the NFI, which was published and released according to the VAS, but our own internal view of NFI is different, right? So we make some restatements based on the economic nature of each income stream, and according to this view, actually, NFI was up 28% year on year during the first quarter of the year. We believe that we have the capacity to maintain this momentum going forward for several reasons. First, the comparison basis, right? The second quarter of last year was quite low in terms of NFI. And secondly, also a few other factors linked to our performance this year. So Jens mentioned the perspectives for Banca. Banca was extremely slow last year in the second quarter, and we anticipate that it will be stronger in the second quarter this year compared to the first quarter. I mentioned also the fact that the bond origination volumes should also increase significantly between the second quarter of the year and the first quarter. And then last but not least, regarding cards, we have also a number of activities which are scheduled for the coming weeks, which should support the payment values, and therefore the fees we will be able to generate on our card portfolio. For all these reasons, it's fair to say that we anticipate our fee momentum to remain very strong and hopefully surprise people on the positive side.
Thanks, Alex. Next question is also for you. Could you explain why your trading income, as reported, increased so much in the first quarter, despite a difficult compare versus the comparable period last year, where you had a gain from selling the Baccio office?
Yeah, you're right. So essentially, last year we generated other income from sale of the Baccio head office, and I think it was around 700 billion dong, if I'm not mistaken. This year, actually, the revenue generated comes from our organic activities. Effectively, what we did is we leveraged the opportunities coming from the volatility in the FX market and the interest rate market to realize trading gains. So we sold, in particular, a part of our credit institution bond portfolios and government bond portfolios, and this allowed us to generate significant trading gains, around 500 billion dong, probably, in terms of these one-off trading gains.
Thanks. Next question is for Jens. Could you explain why your receivables, which includes interest receivables, showed a noticeable increase? And what should we expect the trend to be in the coming quarters, and is there anything to read into that?
Very good question. And so as you see, and that's actually the reason why we put this chart in now for a couple of presentations, we're really trying to keep our receivables as part of the interest earning assets and at a relatively low level. As you see over the last 1 year, and it was somewhere around 1.4, 1.5. Something is a little bit higher, sometimes a little bit and less. And there are a lot of different elements going into that, and usually, and you really also have, you have some receivables, we try to book them and recoup them and try to clean up the book. So this one and particularly comes from the fact that as we started some of these flexible pricing policies, and we put a couple of the cash flows into the zero coupon loans, right? And therefore, if you have these on a cash basis, right, you don't see it, and only at the point in time when really it gets back and paid back together with the principals. But from an accounting perspective, and you need actually to start booking it as P&L. And therefore, and because it's not really cash, and you need to actually book it as a receivable. So that actually has been there all the time. This was already in there, but because it's a combination of a lot of different things, and this number, and what it was in the 1.4, 1.3%, and it was basically not really showing off because other interest rate receivables were taken out or materialized, or we cashed it in. So this month or this quarter, basically now it starts showing because other elements in that book have not been come through. So as we start, and again, that one, that line, so to speak, is constantly in there, and it will continue to be there until these loans are actually paid back. Because even if we wanted to just accrue on a cash basis, the taxmen would not be very happy because they were basically saying we're deferring kind of profits into the future. So they want us to accrue, which then gets into the P&L. So we will continue to use other parts of our interest receivables to somewhat keep that level of 1.4, 1.5. It might be going up a little bit higher, might be going up a little bit lower. But again, this is still a relatively small number, relatively manageable. And even if it would start going up a little bit, just because also the overall book is relatively sizable. So again, this particular notion or this particular uptick was really due to the fact that we have zero coupon bonds or zero coupon loans, and with bullet payments at the end, and then we would actually need to accrue the interest as receivables.
Thanks. Next question is on for Jens on the PBT expectations. The first quarter PBT was already 7.8 trillion, which is 29% of the full year guidance of 27.1 given at the AGM. Were there any one-off or trading related elements in the first quarter that would explain why the full year is not higher? And if not, then what is the reason to explain this math?
So again, I think we were at the AGM saying that the 27.1 is probably a conservative forecast, and that it could actually be higher. On the other hand, we should also not forget that while this is a strong quarter, and probably our current momentum would probably allow us to forecast that probably the outcome will be higher than what we guided, there are still quite some uncertainties in the overall economy. And one of the biggest uncertainties is actually right now, what will the Fed exactly do? How will the world economy develop? Because some of the results which we've seen, the very low interest rate on the deposit side, and the interest rates coming down, were pretty much owed to the fact that the central bank, SBV, decided to decouple the interest rates in Vietnam from the rest of the world, and accepted, so to speak, a little bit an increase in the foreign exchange rates. And I think that has now gone to a point where the foreign exchange rate has depreciated, or the dollar has appreciated so much, the dong has depreciated so much that there needs to be a different stance on the liquidity management. And that might lead to a tightening, and which Alex was already referring to. So we clearly expect that interest rates will rise. And at the same point in time, we see still that some of the credit yields are looking quite aspirational and from some of the banks and in terms of pricing very, very aggressively. So, and therefore, while we are predicting the NIM to go up, and as we said, to the 4.5% on a quarterly basis at the end, we don't know how that really will play out, which is clearly one key element of our forecast. The second one is there is some uncertainty around the bank assurance market. So again, we need to see how that's actually working. But therefore, that's why I'm saying, or that's why we were very conservative when we guided. Now, if these things are playing out as expected, not kind of doing some dramatic reversal of fortunes, then probably yes, we will be higher than what we have put to the AGM. But as I said, I think it's also not like that the world right now doesn't have uncertainties, volatilities. So that's why, and we still want to see the second quarter and to see actually how that's coming in. And then I think we can probably be a little bit more or clearer in terms of what we can guide and if we want to revise something upward.
Thanks. Next question is for Alex. In your first quarter financial statement, there's the industrial sector called science and technology showed up as one of the ones above 1% from only 10 basis points in the last quarter. Could you share some insights on this new sector and the type of customer or customers behind it?
Yeah, thanks. Fair question. So first, let me clarify that when we classify a loan in a certain category, so first we would look at the registered business activity of the customer, and second, we would apply the classification of the General Statistic Office. Right? And if you look at how the General Statistic Office classifies sectors, economic sectors, and you will see that technology is part of a group which also includes professional services. So actually the increase that you refer to relates to loans which were written to customers which belong to these two sectors, essentially professional services on the one hand and technology on the other hand.
Okay, thanks. Next question is for Jens. I think this is our final question. Last week, Reuters ran an article on the large amount of support funding that the SBV dispersed to help Saigon Commercial Bank. Are you concerned about the possible systemic risks alluded to in that article? And are you seeing any signs in the interbank or funding markets to give you concern?
Okay, so I think if there was a crisis, it was probably 18 months back. And so I think we are, I don't see any systemic risk right now. And I think the situation is pretty much contained. The funding there is guaranteed and backfilled by the big state-owned banks as well as SPV. And I think right now it's much more a question of the assets which are really backing it. And I think these assets right now, and after the litigation and all of that, they need to be kind of really managed one by one and need to be evaluated, probably need to be sold, and money needs to be recouped. But there's no immediate profit pressure. There is no kind of timeline when this needs to happen. And because, again, the funding probably from private investors is already relatively low. And as I said, it's coming from the largest banks in the country. So again, from a systemic risk, and I think it's not there. It's just a process which needs to work its way down, and then over time, as these assets are getting liquidated, and then we will see how much they're really worth, and then this money will be used to basically pay back the amounts on the liability side. But again, from a systemic perspective, an effect on the interbank market and all of this, we haven't seen anything, and I don't expect anything.
Thank you, Jens. This concludes our 2024 first quarter financial results presentation. The presentation and replay link will be posted on the IR section of the website soon. Please contact IR team for any additional questions.